Well, good evening, everybody. This is Mark Robertson. We are here to celebrate investing gateway style at the Arch. We're joined tonight by Candace Baker of the St. Louis chapter. Candace has been an active volunteer in the St. Louis area for a number of years, and she's been with us the last couple of years. But Candace, good evening.
Good evening. Glad to be here.
Sounds like your weather's behaving a little bit.
It sure is. It's beautiful.
Then we also have, as one of our co-hosts, the magnificent mathematician from mid-Michigan, Ken Kavula. Good afternoon, or good evening, sir.
Now it's turned into evening up here, Mark. So good eevening to all of you. We're glad to have you with us.
Ken's a mathematician, but you're not a meteorologist or a timeologist or whatever, are you, Mark?
No.
And that voice that you hear, we were sitting here talking about baseball, and inside just showed up. So Cy Lynch from Atlanta, Georgia, diehard Atlanta Braves fan, and an investor and educator in this community for a long time. Good evening, Cy.
Good evening, Mark, and everybody. Glad to be here.
Cy, I have a 20-second story to tell you. Mark and I did a face-to-face presentation about 2 Saturdays ago in southeastern Michigan, and I had the pleasure of speaking with a woman that I had never met before, but that had been to many of our roundtables, as well as a lot of the other things that Mid-Michigan does. And she said, I would have known you anywhere by your voice. She says, I can pick out you and that Lynch fella anywhere by the way they sound. Okay.
Oh, that Lynch fella.
I just thought you'd appreciate that. Okay.
Well, thank you, kid.
You've been the other Lynch for quite a while with Uncle Peter Lynch.
That's right.
All right,
Uncle
everybody.
Peter, you don't hear as much about.
No, he's
lately,
gone pretty quiet.
Yeah.
All right, the agenda tonight's pretty straightforward. We're going to spend just a few minutes talking about a few St. Louis themes. That'll take up 15, 20 minutes or so, depending on where the conversations go. And then we'll head into a traditional roundtable. So anything else, Ken? And Candace, I believe we could probably be fined and incarcerated for hanging ropes on the St. Louis Arch. Is that correct?
Probably could.
I'm ready to go. The deck looks really good tonight, Mark. Okay.
All right. Just quickly, no investment recommendation is intended. You guys all know this drill. This is an educational demonstration. Everything that we do here is to illustrate a bunch of stuff that's 80 years in the making, a bunch of time-honored practices by the modern investment club movement, right down to the discovery of stocks, the analysis of said stocks, and the deployment in designed portfolios. So we're basically going to touch on a few of those things tonight, basically talk about real companies in real time. You are expected to do your own homework when it comes to making a decision about any of the companies that are mentioned tonight. If we happen to own any of the companies, we'll try to remember to let you know about that. If you would like to be added to an event email reminder list for this event, it's a monthly event that we do. This webcast since 2010, as you're going to see here in a few minutes. You can send an email to nkavula1@comcast.net, but better yet, go right to the Mid-Michigan page for Better Investing and use the fill-in form on that page. If you'd like copies of the slides, if you have follow-up questions, our two email addresses are down there at the bottom of the page. I don't think we have that fill-in form, but it's pretty obvious if you go to the Mid-Michigan betterinvesting.org page.
And just make sure that when you're on that home page, you scroll all the way to the bottom. That form will not be visible when you first log on to the page, but as you scroll to the bottom, you'll see it.
All right, so let's go ahead and get started. We're going to open with a few thoughts that are very St. Louis centric. We have done programs in St. Louis for a long time. I mean, Ken and I have made road trips to St. Louis going back, I dare say 20 or 30 years, Ken, and they've always been wonderful sessions, great audience.
I don't know if it's 30, but it's been at least 18 or 20, Mark. You're right.
Yeah, and some of our favorite programs we've ever done. For the last few years here at the Roundtable, we've set aside this session to go over some educational topics and just kind of celebrate some St. Louis themes. And that one on the upper right there turned out to be a pretty powerful reminder about workhorses, medium-sized companies in our portfolios. And again, we just have had a wonderful time. Candace has been with us on all these excursions, and we are so grateful. And good, clean fun. Anything else you'd like to add, sir?
No, except that the folks from St. Louis are a joy to work with. My wife has indicated how easy it is to work with them, and this partnership should continue for another number of years. It's a great thing to work hand in hand with another chapter and publicize the event to as many people as can possibly come to it. And we thank you very much for the opportunity to work together.
Well, we thank you for presenting to us and letting us have this special time with you.
And Cy, if you ever want to work Atlanta and Hank Aaron into a discussion, we can probably work around that too.
All right. I'm sure we can figure something out.
All right, let's go ahead and get underway. We're going to start with just some quick recognition, very well-deserved recognition for Ray Barr. Ray Barr has been with the St. Louis chapter for quite some time, and he's recently been recognized for his volunteer service. And again, Ray, thank you so much. I think he's in the audience tonight. And Ken had a question about the size of that investment club.
That's a good size club, Ray. If you're listening to my voice, 56 members. I just don't know how you do it. That's a daunting meeting, to say the least. All right.
I wonder if he has a certificate in herding cats, or that's got to be a wonderful situation to watch. We've actually been with a number of the members of that club. I'm pretty sure Jay Peters is in that club also, and there's a number of other St. Louis citizens that we're very familiar with. Anything else here, sir?
Well, I just wanted to update the slide just a little tiny bit. The Thomas O'Hara Award is actually awarded quarterly. So if your chapter, and I know that we're speaking to people from chapters all over the country, if your chapter has somebody that's put in exemplary service over a period of years, why not consider nominating them for the Tom O'Hara Award? It's a great honor for the individual to get, and it's a nice recognition for the chapter as well. And there are 4 of them to be awarded every year, so that's a nice thing too.
And I'm told that at least 10 volunteers from St. Louis are coming to Chicago next month for the NAIC National Convention. And I hope Ray is in that group so we can give him a congratulatory handshake and maybe a high five for like a Cardinal batting circle or home plate award. Good stuff.
I believe he will be there.
Fantastic. All right. All right, we're going to also recognize here tonight, and we're going to spend a few moments talking about this lady and her club. Ruby's been gone for the better part of a year, coming up on a year, and she was a force in the St. Louis chapter. I know all of the St. Louis volunteers would agree. And again, we just want to give a nod in her direction. You can see that there's her information there. I didn't know she was a tennis player and golfer, Candace. Seems like we should have played tennis.
She was great.
So she was founder and president of the Broad Assets Investment Club we're going to talk about, but she was also president of the St. Louis chapter for several years and a very frequent instructor. Any special stories that come to mind or anything you'd like to share?
I can think of, but she was such a creative leader, and I know that with her particular club, being the golfer and tennis player, that was, she met up with a lot of women and they traveled, and then she formed the investment club with them, and she was the president from day one and kept going. She was quite a powerhouse. Did the same for the chapter. She was great. You know, she went to classes, taught her members, and then taught members of the chapter all about the SSG. She was great.
All right, so we're going to take a quick look. This is the actual Broad Assets Club from a few years ago. Sorry for the graininess of the photo, but that is Ruby right in the middle. And I know many of these people are still active, and you know them well, Candace, but um, they're still cranking along. The legacy continues.
Yes, absolutely.
So here's what we'd like to talk about, and we just want to spend a moment digging into this theme a little bit. Well, it's not the first time we ran into them, but we noticed them when they won our groundhog contest at Manifest Investing. We run a stock picking contest that runs from Groundhog Day to Groundhog Day. And we've been doing it for 17 years. And what you're looking at here is the first, 9 or 10 years of the contest and the results. And we noticed that this club out of St. Louis, the Broad Assets, had won 3 times out of 4 years, 2012, 2013, and 2015. And we just got kind of curious. Well, how are they doing that? Because it's a pretty formidable field, as you'll see here in a minute. We got curious as to what are they doing and how are they actually achieving that, edging out the competition. And we'll take a quick look at at least one of our theories as to what they were doing in addition just to picking good stocks. And we basically wrote it up in a kind of a tutorial or a discussion a few years ago. This notion of what we refer to as launchpad investing or victory by escape velocity. And what we discovered for the first few years of the contest, they had this local St. Louis company that was just breaking through into profitability. And they also had their 5 or 6 core type companies, several of them also St. Louis based, but they would always have 1 or 2 of these in the portfolios just in case the company took off and actually executed and performed very well. And that was the case with Lynette. And so that was behind 2 of the 3 wins. And then there was a third company involved for that third championship. And it's just an interesting concept where you try to find a company where their earnings are breaking to the positive and they have an established track record of generally improving sales. And this afternoon at our bull sessions discussion, we actually talked about another one of these, and I just sat back and let Ken talk about his interest in this company that Matt Spielman has kicked around with us. Would you care to share, Ken?
Well, I'm become very interested, and it's a newfound interest. Matt Spielman of the Houston chapter, formerly of the Mid-Michigan chapter. Matt has done an awful lot of work and has been an investor in this company. It goes by the ticker LAZR, and it's so new to me, Mark, that the
Luminar.
name of the company, Luminar, there we go. LAZR is the ticker, and I think it might be the kind of company that's poised right at this balance point where the earnings are going from negative to positive. And that's the kind of company that sometimes can be extremely lucrative in the long run if you find it and then hold on to it. It might take a try or two to actually blast off, but if the company has a great product with good management, there's always the possibility that you're looking at something that's going to give you very, very successful returns over the long term. So I would just urge you to take a look at Luminar at the moment. It doesn't have any positive earnings right now, but it has one heck of an investor presentation, and it has a couple of really, really positive things going for it. We're not going to do a presentation on it tonight, but maybe in 3 or 4 months we'll convince Matt to come to the round table and give us Luminar as a formal presentation for the roundtable portfolio.
Yeah, the company makes laser-based instrumentation for cars, including the rapidly developing self-driving car and all that kind of stuff. So we'll save the topic for later, but it's obviously an area that could be of considerable interest and kind of Gentex-like, only the early days.
Yeah, LiDAR is the buzzword. That's sort of like radar, only using lasers.
Mm-hmm.
But this company is much more aggressive in doing things besides just this particular product. They're moving into the insurance industry, and you'll be able to read about the tie-ins to that. They're moving into the semiconductor industry, and you'll be able to read about why they're doing that. And they have some grand plans. Matt stumbled on the name of the CEO of the company when we were doing some of our work in the bull sessions on the book Life After Google. And in the process of dealing with that book, this Wunderkind's name came up, who's now leading the Luminar company. And that, I think, is what led Matt on the path to saying to himself, this might be an idea that I want to learn about. So
Yeah, I wouldn't.
like I said, I'm a newcomer to the stock, but if you're following the forum on Manifest Investing, there's quite a discussion I've discovered about Luminar off and on, right on the forum there. There's a couple of folks doing a really nice job of discussing it and keeping people informed about what's going on.
So that's a company with a high potential future. And also wanted to point out that back in this time frame, this dates back to 10 years ago, we actually put Universal Display, ticker OLED, in the roundtable portfolio. It's still there in the tracking portfolio. And you can see that this would have been a company, closer to that spot on the graph where the blue arrow is, just kind of emerging with a great product. And I think we achieved escape velocity there. And we're pretty happy with a 20% annualized return over a 10-year time frame, beating the market by 9 percentage points. You can see that Ken in the audience actually went back in a couple other times, so 6-time selection. Good stuff. All right. Also wanted to point out that if you are in the St. Louis area, and for that matter, many chapters with Better Investing have model clubs where you are invited to participate and join up. And they do have a model club there in St. Louis, so we just thought we would make you aware of it. If you would be interested in basically exploring that and meeting the people in the St. Louis chapter, that is their address, and the contact information is available down at the bottom of the page. Any special instructions or observations about the model club, Candace? Are you guys meeting face-to-face yet or again?
No, we're still meeting online. It seems to be the preference, but we're obviously send out the links, and anybody is welcome to attend. And so we meet monthly on the second Monday of every month. Just go to the chapter and find the link, and we'd love to hear you, see you.
And do you guys accept any type of participation from around the country, or do you restrict it to the chapter area?
Meeting, we ask people to be quiet, but afterwards we open it up for all the guests to ask questions.
Very cool. So that opportunity is out there if you are curious about that sort of thing. So back to this Groundhog Challenge and Ruby Lawrence's club, the Broad Assets. What you're looking at here is basically 17 years of cumulative all-time results. And Ken, I know that the ones that are in bold are investment clubs. And this tells quite a story, and I'm sure it warms the cockles of your heart, top to bottom.
Yeah, I'm just very pleased that there's so many clubs on this list, and the key column to me is this all-time relative return. Now, those numbers are a little bit variable when you only have 3 or 4 or 5 years in the contest, 3 or 4 or 5 years of history with the contest. But some of the entrants in here are upwards of 15, 16, 17 years. And when you start looking at portfolios that are returning a relative return, what that means is they're beating the market. But when they can beat the market by even 2% over a period of time that is significant, and I think anything more than 5 years is definitely significant, then I think you're looking at pretty decent stock pickers for the most part. They might have a bad year. I noticed at Bauer City and the individual Charlene Hansen, one of the Mid-Michigan directors, and the B.I. Baker Model Club, which I belong to, as well as Petra Linda's portfolio in 2023 had a little bit of a rough time, but you can see by their relative return column that over the period of time they've been involved with the club, they're doing a really decent job. And again, beating the market by even 2% is quite a feat. We find very few mutual funds that can brag that they've beaten the market for more than a 5-year period by more than 2%. So it's a great group of individuals. I want to brag just a little bit on the Cool Kids Club up there in number 2 with relative all-time return. They've won our local contest a number of times, and these are definitely not any professionals. These are grandchildren, for the most part, of one of our Northern Michigan directors, and they have done just an absolutely bang-up time in competing in these kind of contests. And you can't look over the Orange County Model Club. I think they're probably doing as well as Broad Assets in Bauer City as far as dealing with this contest. Notice that the Orange County Club only has 3 years with the Groundhog contest. So,
yeah, they become eligible after 3 years. So you see they're in there at first place. Again, it is just 3 years, but they've won it twice. And
yeah.
it's kind of fascinating to watch. This is becoming a bit of a free-for-all because Susan Michelik's club there in Janesville, Wisconsin, they're formidable. So you've got the Broad Assets who are in 5th place this year again in the current standings, and then you've got these other clubs. It's becoming quite a competitive arena there. So lots of good, clean fun. You can see the numbers. I also like to point out that Shelley Stokes has not been in the contest for a number of years, but it's kind of interesting that the 7 years that Shelley was in the contest, the aggregate return in the stock market was only 1.6%. So if Shelley re-enters the contest, we're all going to sell all of our stocks and get out. Just kidding, just kidding. But the one last thing I wanted to leave with, because we talk about this thing called the accuracy, or where we keep track of how many of our selections actually beat the market. So how many of our selections actually beat the market? We shoot for 55%, as you'll see here in a minute. I just want you to notice these are actually wonderful numbers, pretty much top to bottom. Ken, I think you might be one of the category leaders here at 57. You can see there's a couple 60s, but you're up there. And again, some of the names that you hear around here, including Kim Butcher and Charlene, panelists that have been presenters, and the late Nick Strategos. There's a reason they're here. Anything else you'd like to add? Any questions or comments?
No, it's just that going over this kind of data occasionally just kind of makes you a little bit excited about what you can do as a group, or what you can even do as an individual when you're pulling together some stocks, just, anywhere from 5 to maybe a dozen stocks, and then letting them sit for a year. You can't go in and mess with them. So let them sit, and you're, sometimes you have a real dog that you've chosen and it drags the whole thing down. But if you've done a nice job of picking 5 or 6 or 7, then you have something that is equal to the task of balancing out your dog, and you end up with a fairly decent return. And these people seem to be very adept at making that happen. The key is looking at their portfolios, and they're all listed for people to take a look at on the Manifest Investing site. So if you ever get the urge, you can look at any of their portfolios for the current year on the Manifest site.
I will give a special nod to that bunch down at Space Coast in Florida. That's the north half of Florida, and they've had a few times when they selected as many as 20 stocks. Joan Fosdick is one of the key influencers there, along with Laura Scott and various others, and they've been quite a force here over the last 3 years. And like I say, this is entertaining to watch develop. All right, Ken, I have 8:25. Do you want to just go ahead and transition into the regular program?
Absolutely. Let's do
Okay.
that, Mark. Okay.
All right. So we just talked about accuracy. So let's talk about the performance of the tracking portfolio for the investing roundtable. And
Well, here's our,
go ahead,
okay,
Ken.
go on.
No,
Well,
go ahead.
here's our performance. And we were hoping the last time we met with you at the round table in March that we would notice our performance moving above the orange line, and indeed it has done that. That orange line represents um, the task that George Nicholson set for investment clubs when he told them you should be able to beat the market by about 5 points. That's where that 15% idea came from, because he knew the market had done about 10% over history, and he said you should be able to aim at 15 and do it consistently. We're actually, with our ability to view data in a kind of a constant stream rather than just quarterly or semi-annually, we're able to actually change that goal just a little bit and make it read, let's beat the market by 5 points no matter what the market is doing. So right since inception, in that dark blue box at the top of the screen, you'll see that the market has done 11.5% as measured by the Wilshire 5000. That's an index fund made up of 5,000 stocks, and that's what we use as our benchmark. Our rate of return since inception, and it's going on 14 years now, our rate of return is 16.6. So if you do a simple subtraction, you see our relative return, or how much did we beat the market by, is 5.1. And you see that blue dot that's just rising its head above the orange line right now. We like to stay above the orange line and have been able to do that pretty consistently since around year 7.5, 8. We've managed to stay above that orange line. It's a great goal, but even those returns prior to the point that we passed the orange line, even those returns are very, very good returns. If your investment club can point to a return of even 1 or 2% above the market, then you're looking at really, really substantial, excellent returns. And that's not a real easy thing to do. So give yourself a round of applause. Our accuracy performance is just a little bit shy right now. What is our accuracy performance? I'm not reading it on the table here anymore,
About
Mark.
49%, and we're shooting for 55.
Okay, we'd love to push it up a couple more percent. But we're, you know, when you get half of the decisions that you make correct, and you make 3 or 4 or 5 really nice home runs in the process, you have a pretty highly performing portfolio.
We're going to go 4 for 4 tonight, so we'll be doing great. No, I'm kidding. There are no guarantees. I'm involved. The odds are against us. All right. One of the things that we did want to show, this is just an appetizer from some of the slides we're going to go over in Chicago. During the roundtable presentation, I'm doing a presentation on the decision making associated with selling stocks. And again, this is just to reemphasize the point that the roundtable has done fairly well. This is the answer to the question, what if you had not sold anything? I mean, we've sold a number of things from the tracking portfolio. What if you just sat on your hands, buy and forget, so to speak? And basically, if we turned all those sell transactions into just keeping the stocks, I think you can see that this is actually a huge difference, 12.8 versus 16.6. And even though it's beating the market, that's a massive difference over time. And it just points to some of the selling disciplines that we talk about in the better investing circles really being important to embrace, get your arms around. You're never going to be perfect. We admit to falling in love with a few of our stocks and hanging on to them in the roundtable longer than we perhaps should have. But you do want to always be diligent and trying to achieve some level of discipline. Okay. And this is kind of the flip side of that. You don't have to get carried away with selling. You want to be very prudent with selling, but this is our update of the Microsoft slide. Again, this is just to give you some perspective. Again, our return is 16.6 since 2010. We found that of our 799 selections, 259 of them actually check in at less than $1,000. We put $1,000 into each decision that we make. Well, 259 of them were either locked in at a number below 1,000 or they are current positions at a value less than 1,000. And if you take and add up those deficits for all 259 positions, you get this number. But lo and behold, if you look at it, and we're going to look at the portfolio here in a second, if you look at just Microsoft, which has been purchased 5 times, so $5,000 invested in Microsoft is now worth $103,000. These are the gains. We have gained nearly $100,000 on our $5,000 investment, and I think it's clear that that more than offsets the losses. So again, every time I see this slide, I have this what are we afraid of notion. What are your thoughts? Cy, are you okay with this one?
Yes. In fact, I was thinking now, Microsoft is exceptional, but you could take a number of the top gainers in the portfolio, and it might not be this dramatic, but it would still astound you.
It'd still be pretty good with any of these. Yeah.
Ardelyx, Alphabet Book, any of those. But one of my favorite things to say when you talk about the accuracy and so forth is remember that all you can lose is everything of an investment. But the sky's the limit on the gain.
That's right.
And that's the thing. Those 259, few, if any, went to zero. So, the all you can lose is everything. You got out before you lost everything. But the reality is all you could lose is $1,000.
Absolutely.
In Microsoft's case, all we could have lost was 5,000. But look at the gain. So as long as you do your homework, a dud or two's not going to kill you, or even, the 50% accuracy, even if half underperform, those half that overperform, odds are going to well overperform the half that don't.
All right. So here is the actual portfolio. You can look at all of the complete portfolio at that public link on the upper right. This happens to be just the top 20 by percent of total assets. And the legend up at the top tells you how many times the selections have been repeated. So again, that Microsoft position, 5 times, $5,000 into Microsoft. This is actually one day before, so that's why the number is slightly different. Yesterday's close. But you can see that some of those are pretty impressive. What's your favorite here, Ken?
I'm answering a question mark.
Okay.
But my favorite on the entire list is I always draw people's attention to Costco. Costco's not even up in the legend up there because Costco's a single one-time choice. And one of my hugest regrets right around the time that we chose Costco for the first time is not repeating that choice 8 or 10 more times. So.
But we did repeat Universal Display a few times, and you can see that 6-time selection has landed here in the top 10. So good stuff. And Ken's going to bring 5 below tonight, so bolstering that position, and just a good collection of companies. Now, Cy's going to bring another one of his consulting services companies, and we figure if he couldn't pick Cognizant or EPAM, he'll probably find another one to bring here tonight.
Quit picking on Cy, Mark. All right.
Okay. All right. Overall, if you look at the overall situation in terms of the portfolio, health of the portfolio, this is a wonderful place to be with an average sales growth forecast in the 13 to 14% range. Excellent quality companies. We're a little light on the par. So we want to pick companies with good pars and maybe do a little bit of trimming in the not too distant future of some of the weaker return forecasts in the portfolio. But we don't even need to get too carried away with that, as we've demonstrated with the previous slide. All right, just real quickly, sometimes the decision is taken out of our hands. Johnson & Johnson's purchase of Shockwave basically took a couple of positions out of the portfolio. And then I don't remember the private equity company that took MDC Holdings out, but we also lost that one, but they served us well. You can see by the return records here. And then Victory Capital is the only company in the tracking portfolio that has a relative strength index up at 82. That just means it's potentially overbought, red hot, and still looks pretty good. I don't know, Matt, if you're, or is Matt still with us? Still
Yeah,
feel pretty strong
yeah.
about
They
Victory?
just announced a major merger with a unit of Credit Agricole, which is one of the largest investment banks in Europe. They have a subsidiary that had a U.S. subsidiary with about 100 billion in assets. Victory is 170, so they just grew by about 35–40%. Will run the business and has a 15-year co-marketing agreement. So very good news, yet to be digested in everyone's forecasts, I'm sure.
Yeah, it looks like they're pretty much firing on all cylinders, and we'll hope for the best. All right. So with that, any other thoughts on the portfolio or closing comments?
I think we're ready to hear our stock presentations, Mark.
All right. So we're going to start with Candace. And Candace would like to share some thoughts on Air Products. Go ahead, Candace.
Okay. Air Products was a company that my club owned and was doing pretty well, and then kind of dropped down in February when they had some disappointing earnings and kind of lowered guidance. And since that was, like I said, in February. And since then, I had noticed that Morningstar had raised Air Products to a wide moat from narrow and had raised their fair value a good bit. And that Barron's had an article about investors may want to give hydrogen a second chance. So I thought, well, maybe there might be some upside potential here, and I would share it with you tonight. Air Products is one of the largest industrial gas companies in the world. Helium, hydrogen, oxygen, nitrogen, and argon. They are the #1 hydrogen supplier in the world. Hydrogen is a zero emissions source of energy, and it's used by the refiners to facilitate conversion of heavy crude to a lower sulfur content to be used in gasoline and diesel. They also design and manufacture equipment for air separation, hydrocarbon recovery and purification, and natural gas liquefaction. They kind of are in a lot of different industries: metals, glass, chemicals, energy, food, medical, and just general manufacturing. The slide that you see here kind of shows you their global presence: 45% in North America with the US and Canada, 3% down in Latin America, 26% in Europe, Middle East, India, and Africa, 16% in China, and 10% in Asia, ex-China. Next slide. This kind of shows you their different supply modes. 49% is distributed through on-site or pipelines, and this includes the syngas and the air separation units that they have. And these are long-term contracts, 15 to 20 plus years. Companies are willing to sign these long contracts just to make sure that they have uninterrupted production. And they're even willing sometimes to pay a premium for that just so that there's no disruption. And APD is able to pass through any cost increases to the customer, and there's no problem there. 33% of their product is through a liquid bulk, and these are 3 to 5 year contracts. 11% packaged gas, and then 7% in equipment and services, which a lot of that equipment is used for transportation and storage of gases. Next slide. This kind of shows you their dividend history. They have 40 plus consecutive years of dividend increases. And actually their second quarter earnings came out this morning, and they have increased the dividend a little bit today. Next slide. They have a goal to reduce carbon in the atmosphere by 1/3 by 2030. So that's their mantra, the third by 30. and they're trying to make that a reality through carbon capture projects, carbon-free hydrogen, low carbon projects, operational excellence, and increased utilization of renewable energy. Next slide. They are positioned in energy transformation to hydrogen, and there are 3 different kinds. The gray hydrogen is from hydrocarbons, and Air Products is the global leader in gray hydrogen today. There's blue hydrogen, which is from hydrocarbons with carbon capture, and they will be the global leader here once some projects in Canada and Louisiana are finished. And then the green hydrogen, and this is produced from wind, solar, and hydro, and it's used a lot for in the transportation market. And they will be the leader there once they are finished executing the NEOM project, and the New York and Texas project. Next slide. They have 15 billion that they are working on in energy transition. They have some real projects going. Alberta, Canada with blue hydrogen, California with a sustainable aviation fuel production facility with World Energy, in Louisiana, blue hydrogen, and then in this NEOM project, green hydrogen. And NEOM is an area of Saudi Arabia built as a model for sustainable living. There they have green hydrogen-based ammonia production facility that's powered by nothing but renewable energy, and this will be on stream in 2026. Next slide. They also are the world's leading provider of patented LNG technology and equipment. Next slide. And they're working with Cummins on hydrogen fuel cell trucks. Air Products currently uses about 2,000 heavy-duty trucks to deliver their products, and they plan to convert the fleet by 2030 to hydrogen fuel cell. They're working with Cummins to develop the hydrogen fuel cell electric powertrains, and delivery of hydrogen fuel cell trucks are also in progress. Next slide. They have a project in Jazan, I don't know if I'm pronouncing that right, but Saudi Arabia. And this is where they take sulfur residue and mix it with oxygen, and then it is gasified to produce a synthetic gas almost equivalent to natural gas. And this is going to be used to power the turbines for Saudi Aramco. And here, Air Products owns about 50% of this particular project. Next slide. In the recent news, there was an announcement that they have plans to build the network of commercial scale multimodal hydrogen refueling stations in Canada. They have received funding to build 2 large-scale hydrogen refueling stations in Germany, and they were also again earned a spot on Barron's 100 Most Sustainable Companies list for the 6th consecutive year. Next slide. This is kind of a snapshot of the Morningstar report. They have given Air Products 4 stars. As I mentioned before, they just raised their moat from narrow to wide and raised the fair value from 288 to 307. They kind of qualify for that moat because of the barrier to entry, their long-term contracts, the high switching costs, and the predictable cash flow. And of course, they have exemplary capital allocation. Next slide. I was kind of looking under the search bar in SSG Plus, where you can kind of get some stock ideas. And when I clicked on the heat map, I noticed that you can kind of see it's small there, but in the basic materials area, it has popped up, and it looks like other people have been doing SSGs on the company as well, and the results seem to be pretty favorable. Next slide. Now this is latest value line that came out dated last Friday, April 26th. At that time, the price was $231.16. It closed Friday at $236.08 and closed today at $236 and some change. So hasn't changed much. It kind of was all over the place that with the earnings that came out today. It had run up, it ran down, but it settled back right where it was last Friday. But you can see that Air Products has a safety of 1, beta of 0.9, 18-month price target of 288, which would be 25% upside, and the 3 to 5 year projection was for a price of 360 to 440, with an annualized total return of 14 to 19%. It also, with the current price, you can see that's below the value line. So the idea is that it will gravitate back to the value line eventually. They also have a 3% dividend. Their current position, the current assets are greater than the current liabilities, with $2.2 billion in cash. Company's financial strength, A++, and earnings predictability at 100. So doesn't look too bad here. Next slide. And this is where I was going to talk about the triple play. I know you have talked often about George Nicholson and all of the investment wisdom that he shared with us. And he had a concept about a triple play. And as I was looking at the value line, I thought that Air Products might fall into that category. Although I noticed Manifest Investing doesn't have it come up. If you do a search for triple play companies, it's not one of them. So maybe I guess I should call this a triple play wannabe, but I think it's kind of close. But there were 3 metrics. Oh, go on, Mark.
I was just going to say it's probably pretty close on the profitability, but go ahead. We'll see that.
Okay. Okay. So George had said if these 3 metrics, if a company met that, it was a triple play and could offer exceptional opportunities. So the first metric I want to look at was a depressed price of the stock, which would be an elevated par. And in this case, a par of 14 to 19% seemed elevated to me and in not such a bad spot. Next slide. Number 2 would be increased profit margins can produce increased earnings per share and a higher price. As you can see, the operating margins have been increasing. It looks like it's projected to go down this particular year, but the 3 to 5 year projection is for 36% on operating margins. And we kind of see the same trend down here with 2023 at a net profit margin of 20.3, with the 3 to 5 year projection of 22.4. So I kind of thought it looked pretty good from that perspective too. Next slide. And number 3, just a potential for PE expansion. At the time of this value line, the PE was 18.6, and they were projecting 3 to 5 years that average PE would be 23.5. So I thought it didn't look too bad. But like I say, I guess it's a triple play wannabe.
Good enough.
Next slide. Oh, you've got it. Analyst expectations, as I mentioned before, Morningstar has a 4-star, a fair value of 307. The wide moat and capital allocation is exemplary. They say that the ambitious capital allocation plan with fuel will fuel a tremendous growth for many years to come. CFRA has a 5-star buy, 1-year target of 312, which is about a 32% rise. Yahoo consensus analyst estimates was growth of sales of 7.1, 1-year target of 268, which is about a 13.6% increase. As mentioned with value line, 18-month price target of 288. Annual rate shows sales growth of 9 and earnings per share of 10.5. And at the latest selections opinions that came out, it was listed on the screen for a growth stock with low risk and low risk stocks for worthwhile total return. So next slide. In the presentation that they had for on their website, they showed that for the outlook for this second quarter, which they announced today was going to be between $2.60 for adjusted earnings per share to $2.75. They did come out today and the adjusted earnings were $2.85, so they did exceed expectations there, and that was a positive move of about 4%. So their prediction here of it being kind of a negative number, they did better there. They projected for the fiscal year 24 that they would have growth of about 6 to 9%. Now today the revenues came in light. They were down a little bit, and that was due to some lower energy costs that had to be passed through and some unfavorable currency. And there's still continued softness in Asia and softer helium outlook. But they did go ahead and maintain that guidance that for the whole year they would be up 6 to 9%. Next slide. Now this is my SSG, the graph on the front page, and it's almost up straight and parallel. It's not too bad. I did go ahead and enter the endless estimates. You can see those in the little blue and green dots. And my projections are on that dotted line. They have historical sales growth of 8%. My forecast was for 7%. And the 5-year estimate of 17.4 billion pretty much mirrors what Value Line has for the 3 to 5 year estimate for for the future sales. Historic earnings per share came in at 11.6. I was probably maybe too conservative with 8%, and I used the preferred procedure to get that. It gave me earnings of $15.35 for earnings out 5 years, and actually with Value Line they were projecting 17, so it is a conservative estimate there. Next slide. So taking a look at evaluating management, pre-tax profit on sales, 5-year average was 24.4. We can see that 2023 was down from that 22.9, but it was up from 2022, so kind of moving in the right direction. Return on equity, 16.2% with the 5-year average of 15.9. So it was a little lower than 2022, but over 15% and not too bad. Their percent of debt to capitalization, you can see has been going up the last couple of years, and in 2023 was at 43.5. And this was greater than the 5-year average. I think they have been investing quite a bit with all of the new projects that they have going. And I know we like to see something about 33%, but the particular peers in their industry, the average debt to capitalization there is about 50%. So they're actually a little bit lower than some of their peers. Next, looking at liquidity ratios, the current ratio is 1.8, so moving in the right direction from last year, going up. Quick ratio is 1.5, up from last year. And the interest coverage is 16.4 currently. It was a little bit higher before, but still adequate for a company like this with the debt, but it's got such good financial strength. Next slide. In looking at PE ratio in section 3, we can see the current price at 236. Like I said, today it closed at 236 and some more change, maybe 80 cents. The 52-week high was 307.71 and 52-week low at 212.24. So it's kind of in between there, closer to the bottom. I did take out a couple of outliers for high and low PEs, some of the higher ones. which gave me then a 5-year average PE ratio of 25.6. And the current PE ratio is 22.6. So showing a little bit below on what people have paid on average for this company. When it was at its 52-week high, it had a PE of 29, and then the low was at 20. So next slide. So when I made my judgments, I guess it was a little more conservative here. I just went with a high PE of 25, which then times the estimated earnings per share gave me a forecasted high price of 383.8, which is right in between Value Line's projection of 360 to 440. I chose that same 20 for my low PE, giving me a forecasted potential of a low price of 209, and I went ahead and used that for my low price. Once all of those decisions were made, it came up with, it was in the buy zone. The buy zone is between 209 and 252.7. If we're going with high PE ratios, the total return would be 12.8. And with average PE about 10.7. And I believe Manifest has 12, so it's kind of, we're right in between there. This is showing the company. It has, with Manifest Investing, has a quality of 99. It would be a core holding in a portfolio, and that par of 12. So the par of 12, it beats the market, the my par of 9.7, but not quite in the sweet spot. When I sorted on the industry, the chemicals industry, and sorted by quality, Air Products came up right at the top as being the highest quality in that field. Next slide. And here's kind of the price chart. You can kind of see that the big red mark down there, and that's when that first quarter earnings came out, and it really took a dip. But it has started to kind of inch its way back up. So kind of in summary, I guess I think that that they are a long-term growth company, and would be great, but maybe would take some patience with the hydrogen area that they are specializing in. Some of the skeptics say that the cleanest energy is too pricey, but the Department of Energy is investing $8 billion in promoting clean hydrogen by creating 7 hydrogen hubs in the U.S. within the decade. Supporters believe that all the money pouring in now will help bring costs down. S&P Global Commodity Insight says hydrogen demand was only about 2% of global energy in 2020, but could grow to 20 to 30%. And the European Union decarbonization targets could mean U.S. producers could find a significant export market, and that would be great for Air Products. So it has good long-term prospects, maybe take a little bit of patience, and it may be a buying opportunity while the price is lower.
Excellent. Questions, Ken?
Candace, Patricia Fisk has had her hand up for quite a while. I'm gonna, Patricia, you'll need to unmute yourself in order to ask your question. Okay, that might be an inadvertent hand, so let's continue then, all right?
Okay, I think we're good with this. We'll go to the second presentation, 5 below.
I'm going to present a company called Five Below, ticker FIVE. It's probably familiar to most of you. If you don't frequent the store, you might have a grandson or a granddaughter or a son or daughter that frequents the store. I certainly have a number of my younger relatives that think this is just one wonderful shopping experience. And we've looked at Five Below a number of different times at the round table, and we're going to look at it again tonight. First slide, Mark. This first 5 or 6 slides comes right from their investor presentation, and this is the way the company sees itself. The one thing that I'm going to focus on in this presentation right here is the third point, where they claim to have a store model that can give you actually a payback of most of your costs within the first year. You'll see that that model that they tout actually results in an extremely low debt for this particular company. They also have an awful lot of space left to expand in, so we'll talk about that in a few slides as well. Next slide. Their customer base is not the typical Better Investing customer base. They're aiming themselves at middle schoolers and high schoolers, college students, young professionals, and then the parents of these particular folks as well. You can go into Five Below and you can get a nice basket of goods for not a whole lot of money, and the goods seem to be extremely trendy, and they seem to be exactly the kind of things that tickle the fancy of a middle schooler or a high schooler. They're, again, it's not the kind of store that my wife or I would shop in very much, unless we were there looking for trifles to deal with our 5-year granddaughter or our 13-year-old grandson. If we were looking for them, we might very well be shopping there. The average household income is a person with a modest income, less than $50,000 a year. That's about half of their customers that they serve, but they do serve well-to-do customers as well, with about 16% of them making over $100,000 a year. Next slide, please. This is the big plus for this company. They have a store model, and I'll try to explain the graph if I can. If you are looking at the graphs, you'll notice, first of all, what it might have taken to build a store during the particular year that is represented at the very top of the graph. So in 2012, building a store might have cost somewhere around $300K. All right. The year one sales jump up pretty dramatically when they open that store. And if you compare it to the sales in a normal four-walled store, you'll notice that there's a significant comparison decline between what's happening in the normal kind of store versus what Five Below happens to be doing. They claim that people are able to recoup almost all of their initial investment for a new store within the first year of operation. It certainly looks like it from the numbers that they're presenting. Next slide. This is their motto, 3 times, 2 times. They call it the triple double. And they're planning to triple their store base by 2030. And at the same time they're tripling their store base, they would like to double the top line numbers and the bottom line numbers. It's an aggressive goal, but they seem to be on their way to doing it. There's been one big monkey wrench thrown into the process, and we'll speak about that just in a moment or two, but they are very serious about that goal. If you go to the next slide, Mark. I went to the value line sheet and I wanted to see how they've been able to reach that goal with number of stores. And for any retailer, and that includes restaurants, you usually on a typical value line sheet, whether it's the standard edition or the extended edition, you can get a line that's not always there on a manufacturing company. There's no need for it. But for a retailer, you like to see the growth in the number of stores. And sure enough, the 3-year estimate coming from Value Line is just about double the current number of stores that they have. And if you assume or realize that this goal was set last year when they had about 1,350 stores, then you see exactly where that goal comes from. Value Line is predicting that in the next 3 or 4 years, they'll have 2,700 stores. And there's your doubling of the store base. They're looking to triple the store base based on a baseline that goes back 2 or 3 years now. They've held this goal for a reasonable amount of time. Next slide. The Morningstar projections, which appear on the SSG Plus, these numbers are not better investing numbers. They come from the Morningstar database that we use, and since they're provided, I use them. I clicked in the legend on the sales detail estimates and on the EPS detail estimates, and I get those dots to appear when they exist. They don't always exist for all companies. My projections going into the future are represented by the dotted line, and believe me, my projections were made independent of the analyst projections, but I'm always very pleased when I see them roughly lining up together. It shows that I'm on the right track. I want to draw your attention also to the red tick mark on the last price bar. This company is trading right now at around its 52-week low, and it's trading as low as it's traded in the last maybe 18 months or even 2 years. There's a good reason for that. At the last quarterly earnings, Five Below indicated that they were having some margin problems, some profit problems, and it was due to shrinkage. That's a very polite word for shoplifting. They have instituted a wide program to reduce that shrinkage. They had been quite dependent on self-checkout in many of their stores, and they have instituted an awful lot of double checks now to make sure that the self-checkout is being done honestly and that people aren't just walking out of the store with goods. If their advanced program to shrink the shrinkage is successful, then the analysts predict that the profit margin should move back to the kind of profit margins we come to expect from this company. And that goal then of doubling their profit margins and doubling their earnings and top line and bottom line by 2030 is still a doable issue, but they do have this major problem to deal with and to try to solve. Next slide. I've chosen growth numbers of 15 and 18. Here's the value line annual rates box, and it's coincidental that I happen to choose values that mimic the value line numbers. There is no single source that has all the right answers, and in fact, when you're doing an SSG, there are no right answers. There are only reasonable answers. And I think my choices of 15 for sales growth and 18 for earnings growth are certainly reasonable. I like the generally positive movement in profit margins, although if I notice back at the end of the teens decade, the profit margins were a little bit more robust. And again, the company is pointing to shrinkage for a lot of the problems with their pre-tax profit right now. Return on equity above 20 is an excellent, excellent number. And debt to capital, all of that debt to capital, folks, is coming from long-term leases. None of it is actually coming from loans that they have to pay interest on. That's an accounting rule that they have to follow. But if you look at the interest coverage, you'll find that the interest coverage numbers are dash dash, which doesn't mean zero. It means they don't have any debt to pay interest on. Next slide. I looked at member sentiment, both for sales growth and earnings growth. You can see the mean and medians for both of them on the slide. I happen to be right in line with the member sentiment for sales growth. I think that the median sales growth in member sentiment's a little bit light, and I think my number of 18 is extremely reasonable, especially when I begin to consult some of the other analyst sources that exist for this company. Next slide. Instead of using the 5-year averages, and you can see on the slide the 5-year averages were really quite high. The 5-year average of 53.6 on the high side includes an outlier, and it's a true outlier of 89.7 during the pandemic when most of the stores were closed. The low does not include, in my estimation at least, any true outlier, and their low average was 26.6. I have chosen what I think is reasonable moving forward. This company is maturing into a fairly good-sized company, and as that happens, the PE ratios will drop to something that we might consider more reasonable, and I'm going to choose an average of 30 for the sample going forward at the high side and 20 going forward at the low side. That's considerably beneath the averages, but again, I think they're reasonable. That's giving me a low choice for the price of $108. That is the choice coming from choice A, the first choice, based on the 20 PE. Next slide. That results in an SSG that gives me a buy, about a 5-to-1 upside downside, selling at the high return with the high PE, about 20%, selling at the average PE, which in my case would be 25, 30 plus 20 divided by 2, gives me a return of about 15.6%. I think that's right in line with the analysts that Manifest uses to compute their values. Manifest was showing 2 days ago when I prepared the slide a 16% return. I think we're basically on the same numbers. And Value Line is showing a 3 to 5 year return of somewhere between, I'm sorry, not return, of price appreciation, somewhere between 13 and 25%. And I certainly think both of my values on the SSG nestle into that Value Line range. So I'm getting validation from other sources for my study. I think it's a relatively decent study. And my suggestion is that you take a good look at this beaten down stock selling right now at one of its lowest points in the last 2 years, and maybe consider it as a stock that you might want to own.
Very good. Thanks, Ken. And we will now turn our attention to the Atlanta Braves. I think they have the day off, and the score check right now, Cy, is the Tigers are beating the Cardinals in the 7th inning, 9-6.
Oh my goodness.
I also wanted to mention just real quickly that you bought this company pretty close to right there.
Yeah, I was going to say that Ken, I respect Ken in so many ways, but my gosh, Ken, all their stores are open.
I know.
What kind of
I mean,
pick
it's
is
such
that?
an easy cup. No courage whatsoever.
Really? I mean, my goodness. And of course, Mark briefly mentioned Nick Strategos earlier in the groundhog competition, but I believe Nick was the very first person to bring Five Below to the round table.
He was quite an advocate.
Yes, and then I did, and now Ken has. And tonight we're going to talk about INFY for a little while. I last looked at this for the roundtable back, I think in 2016. I only see one pick in my records. I don't know if the audience did it or if someone else grabbed it, because I think it's a 2-time holding, as
it's a 2-timer.
We'll see.
I may have been the other one.
Perhaps you did.
Okay.
But it's an oldie but goodie, and I will go ahead and disclaim and also say that I happen to own the company as well. But here you can see it's relatively up, straight, and parallel. It's in the information technology consulting industry, as Mark alluded to earlier, right in line with Cognizant and EPAM, and those, of course, are are Roundtable Holdings, but Accenture and others in that industry. Let's go ahead and you could see Value Line. I'll mention too, the Value Line has decent things for it. Well, here's 20%, 18-month, and a decent range for the long term. How did I find it? I just decided to look at the portfolio. Here is the Roundtable portfolio ranked by par, and I've cut out some of the very high yellow stocks, but you can see companies that are I'm familiar with and have good quality and good potential return. But tonight I decided I wanted to look for a yield, just give us a little bit extra boost in the uncertain market, both giving us some of our return in cash, but also maybe lending a little stability. And you could see InMode, Excellus, Five Below, all are no yielding companies. So Emphasis caught my eye for a very high quality potential returning company. Next slide. In keeping with that yield emphasis, I went ahead and ranked the portfolio by projected yield. And here you see that again, Emphasis is relatively high in the yield. And if you then skim over and look at potential return with high yield, you see that Emphasis is the only blue-green, that being highest quality, excellent quality, with a above our goal of 5% return over par, 5 percentage points over par return. You do see Teletech Holdings, which is a holding that we really should get rid of, so I don't have to keep looking at it, Mark. But we have no interest in dealing with that one. That's one of those under 1,000.
Yeah, I know. I noticed
earlier.
that. Bold.
Yeah, and we won't talk about who brought that to the round table. Here's a quick industry study for the information technology services industry. Again, ranked by a par. And you've got some companies that have quality and excellent quality and good pars, but again, they're all either zero dividend or a little lower than the financial strength I'm looking for tonight. Genpact at 79 is right at the 80 I'm kind of interested in this market, but I decided to go with Emphasis. Next slide. Here is the greeting on their homepage. It just says champions evolve, digital first, cloud first, AI first. And then you go in to explore more of the company if this is the client's homepage. I, of course, jumped into the investors, and let's talk about the company. It's a global leader in, as management puts it, next generation digital services and consulting. It's based in India, has subsidiaries in Australia, China, and the US, clients throughout the world, and you could see a breakout of the most recent revenues, about 60% North America, a little less than a third, between a third and a quarter in Europe, and then the rest of the world is the last nearly 12%. Just a little bit in India, but their headquarters is in India, and much of their worker programming and the like base is in India as well. Next slide. The company's been around for about 40 years, and their current emphasis is helping clients transform, as that Champions Evolve screen said, digitally impacted by the cloud and the move for everything into the cloud, data and programming And of course, the major buzzword in technology and investing now, AI, artificial intelligence. They have products and services along the full life cycle from the very beginning of consulting to designing, developing, and you can see the rest as far as pulling together a full package and putting it into production for the clients. Next slide. Here's, again, the front page, just to remind you of what the history looked like graphically. You see the numbers on the bottom side, historical growth right at about 9%. And I decided to use 9% as my growth going forward. That's a little higher than the Morningstar estimates that you can see. It's even a little bit higher than the value line. It's in line with the manifest consensus too. But again, there's no real reason not to believe the company can continue to do that. And you see the evaluate management side. The one thing that I just want to use this chart as a bit of a teaching lesson, and Candace's chart for Air Products is similar. You see some red in the trends there, but don't get overly concerned about that. So unfortunately, when you write programs and programs look solely at trends, but not the magnitude of the trends, they can exaggerate things. 2023 pre-tax profit at 23.4% is very strong. That's a quarter profit margin, very high profit margin. And notice it's not even a percentage point below the 5-year average, and it's above 2022. In fact, if you took out 2020, which was a little bit higher strength, you would probably find that it's much closer to the average. Again, profit margins, even for excellent companies, go up and down. Now, that 0.9%, the 9 basis points, if you were talking about a retailer or a grocery with profit margin in the 2, 3, 4% range, that would be huge. But in a company with this level of profitability, that's really negligible. Basically, with the exception of the first 3 years on this chart, 2014 through 2016, profit margins have been quite steady overall. And of course, similar with the return on equity. Notice it's nice and green, but again, it's no huge changes, and similar with the debt to capital as well. Next slide. So here's, you've seen the financial history. Now moving to my judgments, I use the 9% sales. As far as expenses and taxes, I decided to leave that the same. I believe the tax rate is a little above the value line, but it's right in line with the last couple of years. So I decided just to do that, use that rather than tracking value line. But again, I think they were about 26%. So no huge difference. That gives me a potential earnings per share of $1.22 compared with manifest 174 and the BI median in the sentiment for actually I think it's both median and mean was 114. Next slide. Continuing with my judgments, PEs, I used the 5-year average for my high PE. That's a little above the 10-year, but I felt that was appropriate given the last couple of years and even the current PE. Although I did just the 14 really and truly, I've given you an arrow from the 2014 down, but it really didn't come from 2014. It came from kind of my gut looking at the averages of 16, 18, as well as the range as low as 12 and as high as 24 in one place, but 16 or so. And so 14 just kind of seemed comfortable, and it is pretty close to the lowest with the exception of a couple years. Next slide. So all of those judgments taken together gives a potential return with high PE of 18.4% and a potential return using average PE of 12.1. Compare that with the manifest consensus projected annual return using the average PE of 15, and that has a little bit higher growth and profitability. I meant to put a slide in, just a snapshot of the value line report, because I thought the visual was just so graphic, to use a little bit of a pun there. But unfortunately, I forgot. It was kind of a crazy afternoon as I was preparing slides, but I'll try and give you the snapshots. Picture the value line in your mind. And if you remember the analyst report part of value line, are several paragraphs in the bottom middle, kind of the right bottom middle of the sheet. And there are kind of the highlighted, lead sentences to the paragraphs, and then they give a little bit of detail behind the leads. Well, here are the essential leads for Infosys. Infosys recently announced an agreement to acquire InTech, a global engineering research and development service provider. No financials have been released yet. That's a brand new thing. Nobody really knows a whole lot about it, but they expect to close that in the first half. So that's an interesting potential that we'll keep an eye on. Another one, the stock price has taken a breather of late. Well, that can be a positive if the business is continuing to grow and the stock price pulls back a little or slows down its increase. That can be a buying opportunity. We saw that in the graph on the first page. But listen to these two. Again, picturing the value line. Long-term business prospects are solid. And then it goes on to explain why. The last sentence there seems to always be the key to information technology consultants. When the economy worldwide is questionable, these companies don't do well with the market. But as Value Line says, a healthier economic landscape ought to support client spending and higher earnings. But get this, investors looking to employ a buy and hold strategy are best suited here. At the recent quotation, total return potential over both the 18-month and the 3 to 5 year windows are alluring. You saw those in the first slide. Dividend yield is now above the value line median. I didn't read this before I decided to pick Infosys for dividend. And then in addition, holds an above average safety rating and strong scores for price stability and earnings predictability. And of course, all of that boils down into the blue 99 on manifest. So I'm going to add another Infosys. And yes, thank you for bringing that value line up on the screen, Mark, since I forgot to.
Yeah. No problem. Yeah, in fact, we're going to be taking a closer look at the entire industry during a future bull session, and I think this company will show up with slightly reduced expectations over the intermediate term, but I think longer term it's probably going to hold up much like has been presented here. It's one of the better companies in the entire field, so it'll be fascinating to watch it, and as we dig into that a little bit deeper. Anything else, Ken, or are we good to go?
Well, I just want to state that one of the clubs, the big model club up here in mid-Michigan, is going to be challenging Cognizant in it that it holds in its portfolio right now, and it's chosen Infosys and Accenture and Excel Technologies and Genpact as the 4 companies to make the challenge. So it's certainly in a really elite group of companies that we're going to use to challenge Cognizant to see if we think it's still the best company in the industry.
Yeah,
All right, that sounds great.
Yeah, I do think Cognizant is showing some signs of weakness in a couple of key areas that will be interesting to see what your findings are as you dig in a little bit deeper there, Ken. All right, are we ready to move on?
Most definitely. Let's wind this up with beautiful people.
Okay. Well, every time I put pictures of beautiful women on slides, my stock always tanks. So it's a tough one. InMode has been selected previously for the portfolio, I believe, by Cy, and the presentation at that point was shortly after the October calamity over there, and there was a huge stock price reaction to the start of that skirmish, and that continues to weigh on the company, although nobody talks about it. If you read any of the analyst reports or whatever, and I think that's probably from a long-term perspective very prudent. And we'll cover some of the reasons that might be prudent. I did put, and that's foreshadowing on the right there, that is Indiana Jones on here because that is a key to the story also. So InMode, operating out of Israel, Tel Aviv to be specific. So here's just a quick look at the visual analysis. It's a fairly young company. They're basically into cosmetic stuff, surgery and treatments, and basically tugging and pulling on skin to make all of us look more wonderful as we age or lose weight, all that sort of thing. That's what they do, and they do it in a very revolutionary way. So here's a look at the chart. I actually stole that from a selling presentation that you really make your money by buying intelligently or watching for temporary bad news, much like Cy did when Five Below's stores were all closed. He picked the company, said, well, Cy, what are you doing? He says, well, they're going to open them back up. So that moment will live in infamy. Same thing here. These guys are under, military attack, even though it's not direct, it's indirect. And there is a nasty situation there that will ultimately be resolved. But the company has been slowing down with some economic headwinds and that sort of thing, and you can see that in the price bars here. But the earnings have continued to advance fairly well. One of the things that I do find interesting is the company is distributed globally for sure. And if they did run into a situation where they had to redeploy assets, perhaps redeploy manufacturing, I suspect that they could do it pretty well. And I'll show you that they have all the resources they would need to do that if that were actually something that they needed to do. They are headquartered out of Tel Aviv, but they do have presence worldwide. Well, here's the Indiana Jones slide. Basically, they do these treatments without cutting you or doing damage to the surface of your skin, and it's basically held out as the holy grail of plastic surgery. So that's a good thing. I know none of us like to deal with scars and the staples and stitches and all that kind of stuff that can be part of it. These guys have come up with, among their many treatments and methods, this notion of being able to operate subcutaneous and without doing damage to the surface. So that's a pretty big deal. Again, the holy grail of plastic surgery. They do a whole bunch of different stuff, including some traditional treatments, things, but you can see that they are involved in a lot of different types of cosmetic and restorative surgery and treatments. And the one thing that's missing on the slide that I think would put them over the top is if they came out with a tattoo removal service. So that's why I've added that slide. I'm just hoping I might send a letter to company management saying you need tattoo removal, because I think someday all these young people with all these tattoos are going to perhaps want to remove some of them or subdue them. So that's just what ifing. All right. Anybody that can nail down a person like this as their global sponsor, pretty good deal. Ava has a pretty good track record, and she has actually used their services following the birth of her son. And I have forgiven Ava for not picking Sean Mace's nephew and his chips in the Frito Lay's competition. He had the sriracha chip, and Ava actually picked the chicken and biscuits or whatever flavor of potato chips. The srirachas were far better, but we'll forgive Ava for that oversight. And I have a dietary recommendation for her that this would really help her out with her dietary needs. Had to get it in there somehow. So there you go, Ava. Here's a look at how the stock price has behaved over the last 6 months. Again, there's a war going on over there. So the stock price has been all over the place, and it is currently near a 6-month low. And it is suggesting that it's down into an potentially oversold range. So here's some of the highlights. When you take a look at their capital structure and their balance sheets, you find out that they actually have more cash, far more cash on hand than total liabilities. That's including everything. So if they did have to redeploy or make some type of a strategic shift, they have a whole lot of cash to actually put into reserve. In fact, that huge cash reserve drives up their projected return. So we're looking at a company that rhymes with Hugh McManus's hope for a company within 20% of its 52-week low. They're down within 2.5% of their 52-week low. Value Line does not cover it in the standard edition, but you'll notice that Morningstar's price to fair value and the analyst consensus price to fair value is down around 50%, suggesting that this company has a fair value in the 30 to 35 range, currently at or near 16 or 17. That is a very attractive situation. So here's a look at the company. Again, the quality has been improving. You're looking at a 9% growth rate, very nice margins that you heard Cy talking about in the upper 30s, a PE ratio somewhere in the low double digits, somewhere around 12, generates a return forecast of 19%. And again, they have an extremely strong balance sheet, the capability of doing whatever they would need to do, and almost up straight and parallel, fairly young company. And again, the company, anytime we see a stock price languishing for a period of years, while the earnings actually is making progress up and to the right, that's a good situation. And last but not least, when a Baptist minister says, I really like the stock at $23 a share, how can I not like it at 17? So we're gonna go with it at 17 and hope that Cy and I are both right over the long term. I think that's all I've got. Just the Kentucky Derby is this weekend, and somehow that slide is still in there. By the way, Churchill Downs is the best performing selection from last month's roundtable.
You gotta squeeze that in, huh, Mark?
Yes. Well, so far it's early. It's early.
So are you going to meet me in Lexington for the Derby?
We could. In fact, Cy, you weren't there for my selection of Churchill Downs, but you were there in spirit.
Ah, okay.
So Ken, I think we can go ahead with the poll.
I'm searching for the poll, and it seems to have disappeared from my. Oh, there it is. There it is. Thank you.
And full disclosure, I wasn't serious about the Portillo's hot dog with Ava. Although if a bunch of you out there want to eat Portillo's hot dogs, you'll probably need the services from InMode.
I'm sorry that took so long, Mark. Okay.
That's all right. That's all right.
There's the launch of the poll. Please choose one of these, and we'll put an extra $1,000 in the portfolio for the audience choice. We'd like to see. We didn't end up with that small an audience tonight. The warm weather did reduce the audience a little bit, but we hit somewhere between 175 and 185 people. So that's a pretty decent audience for a spring night. Let's see if we can get upwards of 85, 90, 95% of you voting. We're up to 75% voting. It doesn't take anything, doesn't cost you anything. And our technology is such that you can only vote once. So give it a try, okay? We're up to 80. Come on, let's keep voting here, folks. Let's see if we can get that to 90 if it's at all possible. Okay, I'm going to close the poll after I count to 10. We're at 88, folks. 2 or 3 more will do it. And I'm going to close the poll and share the results. And Candace, they really liked your presentation, Candace. So we're going to add an extra $1,000 in Air Products. And Mark, I can't remember the last time you even came in second, so that's pretty good. Okay.
Well, you know, blind squirrels get them every once in a while too.
So I'm going to hide the results, and we'll put in $2,000 in Air Products and $1,000 in Five Below, Infosys, and InMode, each one of those. And they'll start to, we hope, add some appreciation to our portfolio. Mark, I'm looking at questions. We've done a pretty decent job on keeping track of the questions. Could I ask you that you might want to enter a conversation with Nick DiVirgilio? I think that his questions are very specific and kind of personal, and you might want to enter into a conversation directly with him. Okay. Cy, Jennifer would like to know, do you have any comments on the recent cybersecurity breaches that were traced to Infosys?
Not in particular. There apparently was an incident that's been reported actually by one of the U.S. subsidiaries back in, I think, late October, early November, and it impacted Bank of America customers and Fidelity life insurance customers. There was some personal information potentially disclosed in the data breaches. Most of the commentary that I read, just in quickly looking at, first of all, unfortunately, data breaches are not uncommon in the technology world, but most of the kind of negative commentaries wasn't aimed as much at Infosys itself, but just saying that companies relying on third parties for their infrastructure and their data services need to put into place things to protect their clients. And so it's really more of a condemnation, if you will, or a challenge to companies using data consultants and providers as opposed to specific concern over Infosys. And in this case, not to minimize it by any stretch, but I think the total customers impacted were around 80,000. So again, as data breaches go, it's a relatively small breach.
Thank you, Cy. Robin would like to know which of the model clubs in Michigan is challenging Cognizant. Robin, that'll be challenged at the June meeting of the Mid-Michigan Model Club, and that will happen on June 17th, starting at 6 o'clock in the evening. And there are links on our website, on the Better Investing website. Go to the Mid-Michigan chapter, and there are links that will allow you to link into that meeting if you should want to do that. We frequently entertain guests from different parts of the country. All we do is ask that the guests be respectful of the fact that it's a partnership meeting with a sizable portfolio, and that the partners feel they're the ones that should be discussing what's going on, not the guests. So other than that, we'd love to have you. And again, that'll be on June 17th. And the meeting starts at 6 o'clock. We'll probably get to the study somewhere around 6:30, 6:40, something like that. Okay, it's not the West Michigan Model Club. It's the Mid-Michigan Model Investment Club, going by the letters MMMC. We happen to have 6 model clubs in our chapter, and this one is entitled the Mid-Michigan Model Investment Club. And it's on the website along with the West Michigan Club and the other clubs in the chapter. I think that covers the questions that we've been asked, or we've answered a few of them. Thank you to Matt for answering a question or two. We appreciate that, Matt. And a big thank you to Candace Baker and to Cy Lynch. These kind of events are really nice when we can get folks from around the country to come and make presentations. Obviously, the audience appreciated the Air Products presentation, Candace. And Cy, you and I are just going to have to put up with being the tail that wags the dog on this particular evening. Okay.
Yes, you're right, Ken.
Thank you all for coming this evening. It's a nice way, we think, to spend an evening. And again, the next roundtable will be coming up at the end of May. And that'll be on the day after Memorial Day on May 28th. And again, if you're looking to be added to our guest list, where we will remind you about registering for those events, all you have to do is go to the Mid-Michigan chapter webpage. When you get to the front page, scroll all the way down to the bottom, and there's a form there that is so easy to fill out. Fill it out, press subscribe, and you'll be added to our particular guest list. Mark, as usual, my biggest set of thanks goes to you for all the work you do for the chapter and for all the time that you spend helping the investors of our area and the country out. And I couldn't do a lot of this without your help. And I thank you. Okay.
You're most welcome. It's a fun group to swing with.
I want to thank you also for the special feature for the St. Louis chapter and for featuring Ruby. She was a special lady, and we miss her. Thank you so much.
Well, we look forward to seeing you, Candace, along with Ray and the whole posse from St. Louis in Chicago.
Yeah, we'll be there. We'll be there. Look forward to seeing you then.
And I'll join everybody in the thank yous, of course, to Mark and Ken, and certainly to you, Candace. Look forward to seeing all of you in Chicago. And it's a shame that we've lost some of our audience, as I want to close with a shameless plug. But the Stock Up presentation at 8 o'clock in 2 days on Thursday will be Centering Your Portfolio Management, presented by Cy Lynch. So I hope to see a few of y'all there.
I heard a bell ring as you mentioned your name, Cy. I don't know what that was, but we're all set. Again, folks, thanks for coming. We can't do this without an audience, and we're so pleased to have an audience. So thank you for spending some time with us. We hope we see you in a month. Good night, everybody. We're going to sign off.
Good night.